Yes, the Reserve Bank cut 25 basis points, which was expected by the markets and expected by us. There was an unexpected twist, though, which was further rate cuts have been pretty much taken off the table. Not entirely, but it does looks very much like this is the end of the line for rate cuts. There were mild surprises in this review, but in general, we agree with what the Reserve Bank is saying in this statement. We believe that the Reserve Bank still has optionality, and by optionality I mean that they still have the ability to cut rates further if indeed economic environment requires it, and in particular the inflation outcome in future months require it. Because remember, the Reserve Bank's objective is CPI inflation between 1% and 3%, and they are very confident that inflation will be falling, and we agree with that, but the economy will react positively, in our view, to these rate cuts, and we believe it is also appropriate that after 3.25% cut in rates, the Reserve Bank does pause, and indeed that pause may end up being the low point in this interest rate cycle. So the economy will react very positively, not necessarily to this cut, but the accumulated cuts that we've had since August last year. Approximately 40% of mortgage holders have still got to roll over to lower mortgage rates, and we believe as they do so, that will continue to be stimulatory for the New Zealand economy, but also be good for confidence. And confidence is very, very important. We've just coming out of a recession, and confidence has been at a very low ebb, and we believe that lower interest rates will be quite positive. Furthermore, we believe that the Reserve Bank is absolutely on the right track. We've been advocating for some time that the Reserve Bank shouldn't necessarily cut rates forever. We believe it is far better for the New Zealand economy for rate cuts to come to a stimulatory level and then have a long period of stability. And we believe that stability in interest rates at a low level will be the main reason why we get an economic recovery over 2026 and into 2027. Financial markets, we did see a jump up in the Kiwi dollar after the announcement, and we also saw modest rises in interest rates in the secondary market, and that was really a result of the fact that expectations are now that the Reserve Bank has finished this cutting cycle. As I said, if things get really bad, they will cut some more, but everything else being equal, this will basically be the end of the rate cutting cycle, and that means that markets which perhaps had priced in further action from the Reserve Bank have now taken that off the table and seen interest rates moving up, and the currency has moved up on the expectations that interest rates have also stopped falling. In the short term, we don't believe this announcement will have any implications for mortgage market or mortgage levels. We believe the banks are well funded and have the ability to lend, and remember that banks only make money by lending money. And so we believe that the competitive environment will mean that banks' mortgage rates will stay very similar to where they are. But if we believe this is the end of the rate cutting cycle, perhaps over the next year or so, it may be opportune time to extend the length of your mortgage term.